So next topic is equity analysis and valuation. Let us understand what is the need for a topic like this. Let us say you are looking at stock of an XYZ company which is trading currently at a price of 100. And you ask yourself, is that stock of XYZ at 100 a good investment? And to decide that, what you need to do is find out what is the worth of that particular investment. Isn't it? The current price is 100, but is it really worth that 100? So what you would calculate, this 100 is called as a market price. What you will calculate would be called as intrinsic value. Intrinsic value means trying to find out what is the real worth of that stock. And let us say intrinsic value was 150. Then you will conclude that this stock is undervalued, and then your decision on the stock should be to buy. Or had this been 70, then you would have concluded stock is overvalued and the decision would have been then to sell. So which means this topic is about how do you find out what is the intrinsic value of that particular stock. And finding out intrinsic value essentially is called equity valuation. Now there are different techniques you can employ to do that. So this flowchart you can make along with me. You can roughly divide this valuation methodology into three parts. The first one is discounted cash flow models. The second category of valuation models are relative valuation. At times we simply call them as comps or comparables. The third one is asset based, and in fact there is a fourth one as well, though it is not in level 1 syllabus, called residual income. Okay, so these are the roughly 3 or 4 broad categories of valuation models that we have. Now this discounted cash flow model, we'll just build an overview first. We can further divide into 3 categories. The first model here is called dividend discount model. The second model is based on FCFF. What is FCFF? Free cash flow to firm. And the third one is based on FCFE, which is free cash flow to equity. Then relative valuation models. We can do valuation based on price earning multiple, PE, or we can do valuation based on price to sales multiple, price to cash flow multiple, or we can also have EV, which is enterprise value, divided by EBITDA multiple. So price to earning, price to sales, price to cash flow, EV by EBITDA. And asset based valuation model, we can do valuation by taking the asset at book values, or we can valuing those assets at market values. Are we done? So let us start in a sequential way. Let us first start with the dividend discount model. The origin of DCM models was done by a professor called John Burr Williams. So he was the one who coined this original idea of, or which he applied this idea to equities. He said value of a share is present value, or value of any asset is present value of future cash flow. Have we learned to value a bond like this? Value of a bond is present value of future cash flow. So in the same fashion, he said value of an equity share is present value of future cash flow. But let us say you're a retail investor now. You buy shares of some listed company. Let's say in India you buy shares of ONGC, and you decide to keep those shares with you for 5 years. then what is the amount of cash flow, or what will you receive every year? Every year you will receive dividend. And in the 5th year, when you sell the stock, you will receive dividend as well as whatever was that value of stock by the end of 5th year. So these are your future cash flows. When you discount them backwards, you get value of that particular share. Are we fine here? So now let's do a series of examples to understand this. Example number 1. Let us say a company expects to pay, so let me just simply call this as a dividend schedule. Okay, so what kind of dividend are we expecting from the company? Year 1, 2, 3. We are expecting a dividend of 10. We are expecting dividend of 50. We are expecting dividend of 20. Market value of the share by the end of 3rd year is expected to be 150. Now, how much do I expect to earn on this share? Cost of equity, let us say, is 17%. How is this cost of equity calculated? Yes, we've learned this in corporate finance, that either we can use CAPM model, or we can use Gordon growth model, or we can use a built-up approach, or there are multiple other approaches that you'd learn as you would progress in this course. There's a FEMA and French model, Pastor-Steinberg model. So there are multiple ways in which we can calculate cost of equity. But essentially what that 17% means is how much do you expect to earn on this stock, or the risk which stock has inbuilt in it, how much return is justified for that risk, and that is 17%. So how do you value this stock? Present value of future cash flow. So let's do it together. Press the cash flow button on your calculator. Say second clear work. Go on to cash flow 1. Are you on cash flow 1? Now say 10, enter, because that's the amount we are receiving at time 1. So say 10, enter. Go on to cash flow 2. Yes, how much? 15, enter. And cash flow 3 should be how much? 170. So cash flow 3 would be 170. Enter. Press the NPV button, set your I as 17 and compute NPV. 125.65. Okay, so this is the intrinsic value of the stock. That means this is what the price justifies. So if the market price of the stock is 150, stock is overvalued. If the market price of the stock is 100, then the stock is undervalued. Are we fine? Now let's do one more analysis on this. On your cash flow function, say second clear work. On your cash flow function, say second clear work. Now what if I purchase this stock for 125.65? Then how much do I earn? That's what we want to see. So in your cash flow 0, how much cash are we paying as of now? 125.65. So minus 125.65 should be your cash flow 0. Are we okay? Now come on to your cash flow 1, say 10, enter. Cash flow 2, 15, enter. Cash flow 3, 170, enter. Have you done that? So we have inserted 0 as minus 125.65 and then these cash flows as 1, 2 and 3. Now instead of NPV, now press the IRR button and say compute and see how much IRR are we earning on this. 17%, which means we have valued that stock in such a way, this 125.65, that if the stock gives us these cash flows, then the rate of return that we will earn is going to be 17%. Now this 17% is actually called the required return. 17% is called the required return. This is what we expect to earn. Now tell me, instead of 125, if the stock price was 100, would your IRR be higher or lower? If the current market price of the stock was 100, not 125, experiment, put your cash flow 0 as minus 100. Make your cash flow 0 as minus 100 and compute IRR. 27. That means you would earn more than what is required. So can I say that if I earn more than what is required, then stock is undervalued? Correct? And if you earn, is it clear? And if you earn less than what was required, then the stock would be overvalued. For example, instead of 100, if the stock price was 150, then your IRR would be less than 17%, and then the stock would have been overvalued. Is that okay? Any questions you want to ask? Okay. Example 2 now. You expect a stock to pay a dividend of 20 forever. That means that stock will keep on paying that dividend of 20 forever. Cost of equity of that stock is 10%. What should be the value of stock? So we apply a simple perpetuity formula. We say that cash flow divided by the discount rate. So in this case, 20 divided by 10%, value of the stock would be 200. Example number 3. This will take us some time now. A stock just paid a dividend. Okay, so on the exam now I want you to focus on two things. If you see this word just paid a dividend, that dividend is D0, what we have already received in the past. If you see the word current dividend, then this would be a D0 again. Okay, what we've already received. Now, in corporate finance, we have learned Gordon growth formula. Okay, we said value of stock at time 0 is equal to dividend of time 1 divided by KE minus G. And this formula is nothing but a valuation of simple growing perpetuity. In the previous example, when we solved that question, we said D1 divided by KE. Right? This was a constant perpetuity. That means the cash flow you will receive every year is constant. But what if the cash flow every year you are going to receive is going to increase? Then we said D1 divided by KE minus G. And how do you calculate D1? It is D0 into 1 plus G divided by KE minus G. And how do we calculate that G? That G is a function of return on equity into retention ratio. So what I want to do with you now, before we do the example 3, is to understand what is the intuition behind this G. Okay, why G is calculated in that particular fashion. So let's build an example around it. Can I clear off the screen? This is year 1, year 2, year 3, year 4. Let us say a business started with an equity investments of 100. First year, net income of that business was 40. It decided to pay a dividend of 20. What should be the closing equity value? Closing equity would be how much? 100 plus 40 minus 20, it would be 120. Next year, opening equity is 20. Company decided to, or they earned a net income of 48. They paid a dividend of 24. Closing equity would be 144. Next year, opening equity 144. Can someone please calculate 144 into 40%? 57.6. Half of 57.6? 28.8. And 144 plus 28.8? 172.8. 172.8 into 40%? 1. Half of 69.12? 34.56. 34.56 and 172.8 plus 34.56, 207.36. Now see what is the net profit margin, or in fact what is the ROE we have for each of the year. Your opening equity was 100, net income was 40, that means your ROE was 40%. Your opening equity is 120, net income 48, ROE 40%. Next year again ROE is 40%, 69.12 divided by 172.8, ROE is again 40%. What is the retention ratio? Retention ratio is out of 40 you paid 20, that means you retain 20, so retention ratio 50. The same logic for next year. Out of 48 you paid 24, you retain 24, retention ratio 50%, 50%, 50%. Now what is your G as per the formula of ROE into R, retention ratio? This would be 20, this would be 20, this would be 20, this would be 20. But now the question is 20% growth in what? Is that 20% growth in earnings? Or is that 20% growth in dividends? Or is that 20% growth in equity? 20% growth in dividend. All? Yes. That 20% growth in all the variables. See how your equity is growing. Your equity has grown by 20%. Then it grew by 20%. And if you'd calculate, please cross check. Do it. 172.8 divided by 144. That would be 1.2. Is it? That means even equity has grown by 20%. See the growth of net income from 40 to 48, 20%. 48 to 56, 57.6 is 20%. This is also 20%. See the growth rate of dividend, 20%. So this G makes an assumption or makes multiple assumptions. Number one, it assumed that ROE was constant. And number two, it assumed that retention ratio was constant. And third, most important assumption, which is an outcome of assumption 1, that there is no external debt. Okay, in corporate finance, again we have learned that by taking debt, a firm can leverage and enhance its ROE. But because we are keeping ROE constant, that means inherently we are not allowed to take debt in this structure. Are you following this? If you make these restrictive assumptions, then this formula of G will always be true. And then that would be the growth in equity as well as net income as well as dividend. Only retained earnings, correct. Do you want to write this? Please write fast. So now let us do a Gordon growth formula example, which was your example number 3. Current dividend is 20, ROE is 50%, retention ratio is 30%, cost of equity is 25%. What is the value of stock? So how would you do it? You would say value of stock at time 0 is equal to dividend of time 0 into 1 plus G, which is D1 divided by KE minus G. First we will solve for G, ROE into R. So 50% into 30%, that will give you a G of 15%. So 20 into 1 plus 15%, that would be 23, divided by 25 minus 15%, that would be 10%. So the answer is 230. So yeah, that's a good question. What he's saying is, we've also learned to use Gordon growth model to calculate the cost of equity of the stock, and it was a derivation of the same formula. Okay, so for example, value of a stock formula is D1 divided by K minus G, and then this cost of equity we learn to calculate by saying D1 divided by V0 or P0 plus G. Now when you use Gordon growth formula to calculate cost of equity, what you do is you take P0, because if you had V0, then that V0 must have been calculated using KE. And then how did you get KE? Are you following what I'm trying to say? So what we say is, if the current market price of a stock is 100, then that 100 is implying what is the implied cost of equity at a price of 100. So we reverse calculate. It's an implied cost of equity. Are you understanding what I'm trying to say? For example, let us say market price of a stock right now is 250. Okay, and we have all the data. We have growth rate of, let us say, 15%, and we have dividend expected of, let us say, 25. Then you would reverse calculate that what is the growth rate implied by this current market price. So you would say 250 should be D1, and D1 is how much? 25 divided by KE minus G, and G is already 15%. But you know that this denominator has to be 10%. Therefore, cost of equity has to be 25%. Right? So the current market price of 250 implies a cost of equity of 25. Example number 4. Now, example number 4 and 5 are the type of examples you can expect to be tested on the examination. So I'm going to mark it a 5-star. A firm just paid a dividend of, let us say, 20. Expected growth rate from year 1 to 3 is 25%. 4 to 5 is 20%. And 6 onwards 10%. Okay. Cost of equity is 30%. Find out value of the stock. Now I'm going to solve this question with you, but I want you to understand the process. The way we are going to approach this question is going to be slightly different than how it is given in your notes. So when you'll go back home and you'll start reading notes, you would find that there is a difference. So what I want you to do is that solve all the questions in your notes, but solve it the way we are doing it in the class. Okay, the answer will always be same. So let's see how it works. We know value of a stock is present value of future all the cash flows, which is future all the dividends and the terminal value when we sell the stock. So year 1, year 2, year 3, year 4, year 5. These are the areas up to which dividend is growing faster. The first constant growth rate dividend comes at year 6. Now, the formula of value of stock at time 0 is equal to D1 divided by KE minus G. Can I simply say that value of stock at time 5 would be D6 divided by KE minus G? So using dividend of year 6, we will find out what would be the terminal value of the stock at year 5. Have you followed this? Value of stock at time 0 is equal to D1 by KE minus G. So value of stock at time 5 would be equal to dividend of year 6 divided by KE minus G. Now how to do this smartly on your financial calculator? So let's do it together. 20 into 1.25, 20 into 1.25 equal to STO1. this would be the amount of dividend in year 1. How much? 25. But let it remain in your STO1. Into 1.25 equal to 31.25. Say STO2 into 1.25 equal to 39.06 STO3. Okay, so on the actual exam, you are not required to write any of the dividend. You can do the entire sum on the calculator itself. So we have taken care of growth of the first 3 years. Now into 1.2, 46.87 into 1.2, 56.25. Are we together here? Now year 6 dividend will grow by how much? 10%. So into 1.1, 61.87. Oh, by the way, have you stored the first 5 cash flows in 5 memory slots? This was in STO1, this was in STO2, STO3, STO4, STO5. In case if you haven't, do it now. Are we together here? Now, do you have 61.87 on your screen right now? Yes. So this is the dividend of year 6. Now see this carefully. Now value of stock at year 5, at the end of year 5 would be 61.87, which is the dividend of year 6, divided by 30% minus 10%, which would be 20%. So you already have 61.87 on your screen. Say divided by 20%. 309.3. Now this is the value of the stock at the end of year 5. So this is your year 5 cash flow. Plus we will have one more cash flow in year 5, which is this dividend of 56.25, which is already in your 5th memory slot. So now this number is on your screen. Say plus RCL 5 equal to. So this is the total cash flow in year 5, which is 365. Now say STO5, overwrite the earlier number. Followed? So we have 5 cash flows in 5 different memory slots. Now press the cash flow button. Say second clear work. Come on to cash flow 1. Are you there? Now say RCL1, enter. Done. Come on to cash flow 2. RCL2, enter. Come on to cash flow 3. RCL3, enter. Cash flow 4. RCL4, enter. Cash flow 5. RCL5, enter. Insert 5 cash flows in 5 different memory slots. Have you done that? Now press the NPV button. And what should be IY? 30. So say I is 30, enter, and compute NPV. 175. 170.38. So that's your easy. So what we've essentially done is the first year in which stock starts giving you a perpetual growth, we take dividend of that year and we find out value of the stock a year before that, and then we take all those cash flows and discount them backwards. That's it. Do you want to do one more? Example 5. D0 is equal to 12. Growth rate of year 1 to 3 is 40%. 4 and 5 is 30%. 6 to 7 is 20%. I'm just intentionally making it larger. 8 onwards 10%. Cost of equity 25%. Find out value of the stock using dividend discount model. Let us solve this together now. So please do it with me, all of you. 12 into 1.4. Now we'll just do it on the calculator fast. 12 into 1.4, done. How much? STO1 into 1.4 STO2 into 1.4, don't forget to press equal to, STO3 into 1.3 equal to STO4 into 1.3 equal to STO5 into 1.2 equal to STO6 into 1.2 equal to STO7 into 1.1 equal to. How much is the dividend of year 8? 88.14. So dividend of year 8 is 88.14. Using dividend of year 8, we can find out terminal value at the end of year 7. So this 88.14 divided by what percentage? 15%, 25 minus 10. So this value divided by 15% equal to how much? 587. This is the terminal value at the end of year 7. Now plus RCL 7, add up the dividend of year 7. So plus RCL 7 equal to how much? 667. Overwrite this on the 7th memory slot. So say STO 7. So now we have 7 cash flows. Go to your cash flow function. Say second clear work. Go on to cash flow 1. Say RCL 1, enter. Cash flow 2, RCL 2, enter. Cash flow 3, RCL 3, enter. Just put all the 7 cash flows in the cash flow function. Keep 25 as I and compute NPV. How much? 238.67. And now last example on dividend discount model to help you build some intuition on the formula of Gordon growth model. Let us say D0 is 10. A perpetual growth rate is of 10% and cost of equity is of 20%. If I decide to sell stock at time 0, okay, if we decide to sell stock at time 0, what should be the value of the stock? Will it be 110? We will say 10 into, in fact let me make this as D1. Okay, so we will simply say 10, which is D1, divided by 20 minus 10, 10%. That would give us the value of stock 100. Now please understand, what does it mean? It means I am selling the stock today itself and therefore I am going to get 100, and therefore I am not discounting back the cash flow of dividend of year 1. Because I am selling the stock today itself, I am not going to get dividend of year 1. Have you followed this? But what if you argue that no, I don't want to sell today, I want to sell at the end of year 1. Then what? Will my price increase? So then let's see, if we decide to sell stock at time 1, then see what happens. Then at time 1 you will get a dividend of how much? 10. Do you agree? At time 2, had you kept the stock, you would have got dividend of 11. But you are not going to keep the stock at time 2. But this 11 we need to discount or to find out the value of stock. Are you following what I am trying to say? This dividend of year 2 is required to find out value of the stock at the end of year 1. So this 11 divided by KE minus G, which is 10%, terminal value of the stock would be how much? 110. So total cash flow that I am going to receive at time 1 is how much? 10 in the form of dividend and 110 in the form of terminal value. So total cash flow is 120, and 120 discounted backwards for 1 year at the rate of 20%. How much would that be? Do it. Second clear TVM. Come on, you really need to do it. 120 divided by 1.2, 100. So the value of stock is again 100. What if I don't want to sell the stock at time 1, I want to sell the stock at time 2. Then I will receive two dividends, dividend of year 1, dividend of year 2. But will I receive dividend of year 3? No, but we will have to use dividend of year 3 to find out terminal value of year 2. So cash flow at year 1 would be 10, cash flow at year 2 would be 11, cash flow at year 3 would be 12.1. Now we will use this 12.1, we are not going to receive this, but we will use 12.1 divided by 10% to find out value of stock at the end of year 2, and that would be 121. Let's use your cash flow function. Second clear work. Cash flow 1, 10, enter. Tell me how much should be cash flow 2? 132. Cash flow 2, 132, enter. And keep your discount rate as 20. Keep your I as 20 and compute NPV. Is it 100 again? All of you've got 100? What if you don't want to sell your stock at time 2? You want to sell your stock, let us say at time 5. Okay. So now we will have 5 cash flows. Year 1, 2, 3, 4 and 5. We will use dividend of year 6 to find out terminal value of year 5. So let's directly do this on your financial calculator. Set 10 is STO1 into 1.1 equal to is STO2 into 1.1 equal to is STO3 into 1.1 equal to is STO4 into 1.1 equal to is STO5 into 1.1 equal to is STO6. How much was the dividend of year 6? 16.10. This 16.10 which is on your screen, which is dividend of year 6, divided by 10%. 161. Now this is your cash flow at the end of year 5. So this number which is on your screen plus RCL 5, which is dividend of year 5, 175, and overwrite this in the 5th memory slot, so say STO5. Okay. Now go to your cash flow function. Say second clear work, RCL1 as your first cash flow, RCL2 as your second cash flow. Insert all the 5 cash flows. Insert 20 as your I and compute NPV, and the value of stock again will be 100. So this is the true meaning of this Gordon growth formula, that since the formula is mathematically derived, whenever you sell the stock, you sell it even after 1,000 years, the value of stock today will still be 100, because it is automatically capturing the present value of all future growth in the cash flows. Are we okay here?